What if I told you that you could get a home seller to buy you a lower interest rate on your purchase money mortgage? Sounds crazy, right? It's called a seller paid buy down. And in this video, I'm going to show you how to do that. Welcome to the Crazy About Condos channel. I'm Chris, and on this channel, I talk all about condominiums and other housing issues. If you've recently thought about buying a home or have thought about selling the one that you have, you no doubt know that it's a lot more expensive and difficult to do than it was even just a few years ago. Not only are home prices higher, but mortgage interest rates are way higher. And that makes it real hard for buyers to qualify for a new home mortgage. I currently hold 2 housing-related licenses from the state of Florida. I hold a real estate sales license and a mortgage loan origination license. I've been selling real estate since 2015, and I've been involved in mortgage loan origination since 1986. Long time. And in all those years, one thing I can tell you is that when it gets tough for people to qualify for mortgages, sellers and lenders get really creative. I created this video to show you how to use seller paid funds to pay for a lower interest rate on your purchase money mortgage. But before I show you how to do that, let me explain to you a little bit about how mortgage interest rates work. As you know, as a consumer, whenever you buy something from a retailer, you are buying something that they purchased from a manufacturer or a wholesaler. Like a car dealer. Car dealer buys a car from a manufacturer, marks up the price, sells it to you. A grocery store buys their food from a supplier, marks up the price, puts it on the shelf, sells it to you. Mortgage financing and interest rates are no different. Wholesale lenders offer various interest rates at various prices to mortgage loan originators such as myself. And those interest rates can vary daily. As a matter of fact, they can change more than once on a single day. This graphic is screenshots that I took from a random lender on a random day of 4 of the loan products that they are currently offering. Believe me, there are way more than just 4 loan products available in the market today. But this is just to simplify things. The rate you see at the top is for a 30-year fixed conventional rate. And on this particular day, this lender was offering 6.5%. Below that is their 15-year fixed conventional rate of 5.88%. And then below that is their 30-year fixed FHA rate, which is another loan product, at 5.75%. And then way at the bottom is their jumbo rate. And a jumbo loan is anything over $806,500 for most of the United States in 2025. And their rate on that is 6.63%. Also notice that next to those interest rates, they are giving us what's called an APR. The APR stands for annual percentage rate, and that it basically represents the interest rate plus the closing costs that are associated with that interest rate on that particular day, and kind of rolls it all into one and gives us a truer idea of the cost of the loan at that interest rate. Now, the APR is a very important number for buyers to pay attention to, but it's a little too complicated for me to go into in this video. So that's just an example of what a consumer sees as far as interest rates are concerned. So let's take a look at a mocked up wholesale lender's rate sheet. As I told you, wholesale lenders offer various interest rates at various prices to mortgage loan originators such as myself. The graphic you see now shows what you would typically see on a wholesale lender's rate sheet. The column on the left are the interest rates being offered, and the column on the right are the prices for those interest rates. Smack dab in the middle of this rate sheet, you'll see they're offering an interest rate of 6.50%. And on the right, you'll see that that has a price of 0.0%, what we call the par rate. Now I draw your eye up to 6.75, closer to the top of the rate sheet. That interest rate is being offered at 1.0%, or 1 point. Remember that a point is equivalent to 1% of the loan amount. So for example, if you have a $300,000 loan, 1% of that is $3,000. So on that day, that wholesale lender would pay $3,000 to a mortgage loan originator for a loan delivered to them at 6.75%. Now drop down to the bottom of that rate sheet to where the interest rate says 6.00%. That interest rate has a price of -2 points, or -2%. Now 2% of your $300,000 loan is $6,000. So on that day, that particular wholesale lender will charge, you see, because it's a negative. So they're going to charge 2% for a loan delivered at that interest rate. Now you can see where the seller comes in. If you can get the seller to pay that 2%, you can turn around and use that money to pay for your interest rate buy down and lock in your interest rate at 6.00%. So how does this all play out? Well, let's take the example of some sellers who put their property on the market for $325,000. They'd like to get $325,000, but they're expecting an offer of something a little bit less than that. That's how it works, right? So you've seen the house, you love the house, you've got to have the house, you really want to make an offer on the house. So you get with your realtor and you say to Mr. and Mrs. Seller, hey, we'll give you your full $325,000 asking price, but we're going to ask you to pay 2% of our mortgage amount so that we can buy down our interest rate and have a lower monthly payment and save some money over time. So for the seller, that means that instead of selling their property for $325,000, they're going to subtract the 2% on your mortgage amount and say you're putting 5% down. So your mortgage amount is going to be $308,750. And 2% of that is $6,175. So they're going to take their $325 asking price, subtract what they're going to give back to you, and come up with a net price of $318,825,000. Would that be a good deal for them? It's up to them, but they might take it. For the buyer, that means they're going to save on a monthly basis on their payment, and they're going to save some money over time. So let's go back into our example. Their loan amount is $308,750. If they didn't get any money from the seller and they went with the 6.50% interest rate, which remember didn't have any price, it was free, it was 0 points for that interest rate, their monthly payment would be $1,951 per month. Now that is just the principal and interest payment on the mortgage. It doesn't include taxes, it doesn't include insurance or association dues or any of that stuff. Just the payment on the mortgage. Versus if they get the seller to pay the 2% and they are able to lock in at 6.00%, their principal and interest payment on that $308,750 is going to be $1,851 a month, a savings of $100 a month. That means that they're going to have an easier time qualifying for the mortgage. And if you take that $100 savings and multiply it by 360 payments, which are how many payments there are in a 30-year mortgage, they're going to save over $36,000 in 30 years. Pretty sweet, right? So before I sign off on this video, I want to leave you with 3 things. 1, never start shopping for a house until you get pre-qualified for a mortgage. I cannot emphasize that enough. It helps you so much to know how much you can borrow and how much your monthly payment is going to be. 2, work real close with that mortgage loan originator, because there's a lot more involved to the interest rates and prices than what I explained to you today. Much more than I could go through in this short video. And 3, work closely with a competent realtor to make an offer that has the proper wording in it to make sure that the seller pays you the percentage back that you need to buy down your interest rate and save and qualify easier. Thanks for watching the Crazy About Condos channel, and I'll see you next time.